Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Jay Fee, the Vice President of Consumer Banking at PenFed Credit Union, one of the nation's largest credit unions. And Jay spent time not only in consumer banking, the credit union space, but also in auto lending and automotive space in general. And those are areas that I think are both very topical in terms of opportunities for credit unions and banks, and also near and dear to my heart as things we really focus on a lot here at Upstart. So um, I really enjoyed this conversation with Jay. He talks a lot about fintech partnerships, talks a lot about automotive and where the opportunities are there, and how credit unions can more effectively work with fintechs and what those opportunities look like. I think it's a fascinating discussion for anybody interested in this kind of edge of fintech and traditional financial institutions, and maybe what we can do to cross those boundaries and work together. So please enjoy this conversation with Jay Fee. Jay, thanks for joining the podcast today. I really appreciate it.
Thanks, Jeff. It's great to be here.
So I've started asking all of my guests the same first question, and I think your answer will be quite interesting. But I always start with, like, most of us don't grow up dreaming of being bankers, and yet here we are. Tell me a little bit about your career path into this industry. And I think you've kind of been on the banking side and the fintech side, so you've had a little bit of an interesting journey to where you're at today.
I'd like to say it. I like to say that I've committed career suicide about 5 times.
And yet here you are.
Here I am. But fortunately, I've been able to continually reinvent myself. But had the great opportunity back in the 90s, which is dating myself, to spend my first 10 years at Navy Federal Credit Union. Ultimately, I ended up in a position there where I was basically running the originations for auto and unsecured. So, which is a bit odd because it's deja vu all over again now for me here at PenFed. But in between leaving there in 2000 and joining PenFed in 2019, I had a great opportunity to work at the nation's largest distributor of automotive accessories.
Mm-hmm.
So I was able to kind of take my auto financing background and then get to see kind of the aftermarket in auto. Ultimately, I ended up at Volkswagen for about 7 years, where I ran dealer relations. So then I got to see the dealer side of what goes on in addition to auto financing, in addition to car production at the world's largest or second largest manufacturer. And then I got plucked out of there to go start a company at the time that we called Motor Refi. Got plucked out of there by a guy named Nigel Morris,
Mm-hmm.
who helped start Capital One. And we built that into now it's one of the largest refi shops in the country. And took that to all the way to prior to a Series A, and then joined PenFed in my golden years here. Here it's been a great opportunity to take at the time, which was a very small portfolio, and we've been able to, just in 3 years, 9x the total portfolio originations to where this year we'll probably do. We're at a run rate right now of 15 billion in terms of originations, up from 2. So not too shabby.
15 billion up from 2. What's the magic for that?
Well, some of it was just like I said, I had the just blessed opportunity to work in a lot of different places and see best practices. I don't profess to have started really kind of anything new. I've been blessed to be around a lot of really smart people and see what they do, and then mimic that. And so just everything from building highly efficient mail campaigns, and the stuff that we did in the 90s there was stuff that we just brought over here.
Yep.
Risk-based lending, basically trying to make sure you get every opportunity, which can mean, making sure that if you're going to decline a loan, that somehow you monetize those
Mm.
declines. And then, understanding the back end market is very helpful. Yeah, nobody grows up wanting to be a banker, but if you understand that a bank is more than just originating loans, it's managing your balance sheet, it's making profitable loans, it's managing risk, but it's also in some cases selling those loans that you don't want to hold on your balance sheet for whatever reason. Sometimes you're selling them because you can make money. Sometimes you're selling them because you need to clear your balance sheet so you can make more. So, uh,
I like that
so
second part.
exactly,
I
exactly.
love your
So,
answer too. It reminds me of this quote from, I think, Patrick Lencioni, where he said, success is not a matter of mastering subtle, sophisticated theory, but embracing common sense with uncommon levels of discipline and persistence. And I feel like there's so much of that in the lending space today, where it's not rocket science to do this better than average. It's just taking the things we all know to be true and actually like deploying them successfully on an ongoing basis effectively. And that's like, it sounds easy, but it turns out that it's harder to do than it is to say. But it's not all like you have to reinvent the wheel. You've got to, just take the things we know how to do and do them well.
you just said it much better. It would have taken me like 20 minutes to explain that. So,
Well, I read it. It was all saying good writers borrow, great writers steal. All right,
yes.
I steal people's stuff, and it makes me sound smarter. So I want to ask you, there's kind of two categories of lending I wanted to talk about today that you either are or have been involved in historically, which is kind of the unsecured consumer space and the auto refi space, which are, I feel like, underappreciated opportunities by many FIs. I mean, they're relatively small parts of bigger parts of credit union balance sheets for community banks, and large banks are almost rounding errors when combined. Credit unions are a little bit more, but they're still, I feel like, not appreciated for their potential. So I'm curious what you think of. Maybe we'll just start with unsecured. What you think of that, and why? Do you agree that it's an underappreciated, underleveraged opportunity? And if so, why? And if not, then you can just tell me I'm crazy.
No, no. I would say that, at any given point, in the credit life cycle, you find certain programs being the darlings one minute, and then as the credit life cycle changes, they can become the villains very quickly.
Mm.
And it seemed like unsecured got, yeah, it was really kind of in the early 2000s, was really kind of really beginning to gain a lot of attention and attraction, especially for bill consolidation,
Mm-hmm.
credit card consolidation. I think the crash of 2008, 2009 scared everybody.
Yeah, it really stopped. I mean, I
And
had not known the history as much before, but it was like a thing before '08, and then it was not, at least
well,
among traditional financial institutions.
And I think the space was only growing so fast, and you had a lot of players coming into it,
Mm-hmm.
and a lot of players got really big really fast, and you got lending clubs and stuff like that. And then what ended up happening was a lot of people really got the beat down, because it's like any other market. As the players grow faster, and the demand grows faster than the actual supply, then what ends up happening is people get greedy. They start moving further down
Mm-hmm.
the credit spectrum to try and make loans that they weren't making 6 months ago, to continually increase their volumes. So that's certainly that's the history. Now the question is are we heading into the downward turn of another credit cycle coming up? So right now, personal loans have become, and unsecured loans have become, the darling again. Why? Because you can even, as long as you can originate them with whacks that outpace the losses, by 700, 800 basis points, which you can do, then hey, you can even sell these to hedge funds. So, and that's not that way with auto. So, whereas auto is certainly lost a little bit of the luster over the last few years, because people are making so much money on the unsecured, and point of sale is now really taking
Mhm.
off and becoming such a huge source for unsecured originations. And then people are becoming much more wise about just refining their credit cards and putting it on a fixed installment loan. And then you have these new instruments that are coming out, like cards that can easily be convertible to fixed rate loans if you're using it for like large
Mhm.
individual transactions. So you're not paying the high credit card balance of a revolving line that's open. Um, so it's been interesting to watch the cycle. And I would say right now, personal loans and unsecured loans have become quite appreciated compared to where they were.
Do you see, I mean, more institutions investing and making that possible, and anything that you think they're doing well or should be doing better in terms of actually growing and investing in that capability? I know you talked about a
Uh,
couple interesting ones.
well, so uh, banks are good at banking. They're not always good at marketing, and and they're not always good at product creation. So that's generally where the fintechs come in, right?
Hmm.
So fintechs are good at creating products and then marketing those products, but they're also traditionally not very good at things like balance sheet management and banking. So that's where kind of the marriage has really happened.
Mm.
And I would say the banks and credit unions um, have really kind of lagged in kind of their technology. They got married, usually a long time ago in the 60s, 70s, and 80s to these legacy, mainframe backends,
Hmm.
and they're just not nimble, and they built their IT structures around all of that. And so they lost their ability to really create good front ends, things that would work well for the member experience. And their solution usually is to throw money at it to do that. Whereas if you work in a fintech and you come in, and you decide you want to change the application flow. Yeah, I worked in one where we did that every day. So with a bank, you're in 6 months of compliance sign-offs before you can even go out and see, start those types of things.
Do you see
So
that
that's
as like a
limiting in
reason?
terms of product expansion, product change.
Do you see that as a reason that like there's, I feel like there's an evolving fintech plus bank partnership that where banks are able to leverage that, and I feel like some are, I should say credit unions too. I don't want to exclude that, but I think sometimes banks and credit unions think of like, their originations need to be to their current members in their current branches through their current channels, and this idea of a fintech partnership that can bring volume feels different, but it feels like a strategy that can really solve, bring the best of both worlds together to me in terms of what you're talking about from a user experience and nimbleness on the fintech side with the balance sheet management and safety and soundness on the credit union or bank side.
The banks get it. The big ones now get it, and they're trying to change as fast as they can. They'll B of A, the rest of those guys, they're throwing billions of dollars at at making themselves better in those areas, and they're making good progress. Um, but they're never going to be able to be as nimble, as innovative as a fintech. So what they've done now is they basically form relationships with these fintechs. They try and boat race which one is going to be kind of their best, the best of the best, and then they buy them. So they acquire them, and think, and they in the interest of acquiring the technology.
Yep.
Really. And so in some cases it's worked. Some cases it ends up being what actually kills what was good about the fintech.
Hmm.
So but yeah, it's interesting to watch. And depending on how the rest of this year goes, it'll be interesting to see, if the fintechs now, with money's getting tighter, their ability to raise capital. It'll be interesting to see if that continues. A lot of the fintechs are like one trick ponies that are keep trying to find other kind of origination tools, ideas, products. They're struggling a little bit because they realize if they don't get more core service offerings, that the ability to the barriers to entry and the other people that are going to come and just do what they do but do it cheaper
Hmm.
is that's the product life cycle. And you've just seen it just in the last 3 or 4 years of who were the fintech darlings in loan origination 3 or 4 years ago, and look where they are now. So
Yeah, interesting. I wanted to dive down to auto refi. I mean, you spent a bunch of time in auto refi. Let's just start with the core. Like, it's always interesting. You talk about personal loans as credit card refi, and that's really this interesting move from a revolving product to an installment product that has a different risk profile and understandably can be priced differently. But auto refi, on a certain level, feels like unless rates are going down a lot, why is there an opportunity? Talk to me about why you think there's a space for refinancing automobile loans and also why I'm always shocked that in the mortgage space there's like a pretty good refi market, and yet in the auto space a very small portion of originations actually end up as refinance opportunities, and it's always surprised me that that's true. And I'm curious your thoughts as to why it's a good opportunity and why it's not a bigger part of the overall auto lending space.
yeah, so that's great. I think the being at Volkswagen was for a number of years running dealer relations there was a big eye opener to me because I never before going to there I never realized how important the F&I and finance department is to the lifeblood of dealership. Dealers make money through new cars, through sales, through used car sales, flipping and turning those vehicles, and through the F&I and then through the service base. Um, they service bays warranties down, way down, based on you have electric cars which don't really need a whole lot of servicing. They're
Yeah.
they're the minority, certainly of the cars that are being sold. But you have just the dramatic improvements in quality that have happened, and how long cars last now. And so, the dealers have taken a hit in the service bay.
Mm.
The dealers have they've taken a hit with new car sales, obviously.
Yep.
Who can even find a new car these days? And then with used cars, that they had a recent boom, but now I think you're starting to see the horizon on that, with used car prices coming down now. So they're going to be really reliant on the F&I shop, as the breadwinner, probably increasingly in the coming years. And in doing that, for them to make money, they generally are getting incentives from the manufacturer. But those incentives are way down now because there's fewer cars for the manufacturer to even provide. So they've got to make money where they can make money, which generally means it affects the overall price of the vehicle.
Hmm.
So even though with rising rates, it would be intuitive to say, okay, well, yeah, isn't the auto refi market going to dry up because these people, if they originated it at 5%, then rates are going to be 6%. Well, and that will happen to some degree. It'll have some effect, but you can't. A lot of these refi shops are targeting people 30 days after origination.
Wow.
And as the refi shops have gotten more numerous, you have to get to the consumer earlier and earlier, because otherwise they're getting hit, by a ton of people, within the first 30 days to refi their vehicle. So the rates aren't going to move that much in 30 days, and if you're paying basically more than 300 basis points, or you can save more than $100 on your auto loan monthly payment, then you are highly likely to respond to those opportunities that are going out. So as long as dealers have to make that extra 300 basis points, you'll have a market there.
Hmm.
Just as long as the refi shops can get to you in the first 30 to 60 days before, if we end up with interest rates of 19% on car loans, um, then I'm proven wrong on that, because that just means we go up 50 basis points every month. But that's it. It's looking like there'll be some flattening of that, certainly by the end of the year.
Interesting. And what do you think, FIs need to do to think about taking advantage of the opportunity that represents? 'Cause the second part of my question is like, why isn't that a bigger thing for most shops today? The auto refi opportunity, if it sits there and looks like that, why don't we see more of it being done or more focus on it as an opportunity?
Well, the FIs are dependent upon the fintechs to do it. Generally, for the most case, the FIs that do it themselves don't really do it the right way. Uh, they usually get into it. Mailings used to be the big driver on
Hmm.
this. Now it's much more digital methods. So until the FIs decide to focus on it and they get better at their digital methods for origination, they understand it. They hire people out of places like Credit Karma and stuff like that that can kind of teach them. Then they're it's not a big thing. I mean, we estimated the full TAM market to be, we were about a refi of it's $1 trillion market, right? And
It's a
we
pretty good
estimated
market.
that, okay, well, fundamentally, at a certain point, if everything were out there functioning with a lot of really hardcore folks in the business, and you were reaching all the people that you should be reaching, it would be probably somewhere around 100 billion would be refinanced every month.
100 billion
And
a
so,
month is that's not where we're at.
yeah, exactly. So obviously, there's still some room to grow in the market. I think, and even though there's a lot of folks, fintechs doing the refi business, there's only a couple of them that are really doing it well. So
Yeah, it's a challenging space to do well. I mean, just the diversity, particularly if you have a large geographical footprint, the electronic lien and title transfer, the wet signatures, the perfecting a lien in a seamless way without breaking the bank and making it's not easy, right? You have to be smart at underwriting, and that digital process is hard. So it feels like a good opportunity, but it's going to take a lot of persistence and execution to actually do it well.
well, most of the refi shops don't actually make money on the the FI's origination fee.
Mm.
So they make money on the ancillary products.
Yep.
So
That's probably
that's
an underappreciated fact by many, is that how much of that money actually comes from. What do you mean by ancillary products? Just so people are clear on what we're talking about.
yep. So the gap insurance. So there's all sorts of different types of insurance products that are usually sold by these shops, and some of them are you know are actually good deals, and you should do them. If you're at 130% loan to value on your loan, it makes sense to go out and pay for something like gap insurance, in case your car ends up being T-boned, and you're
Hmm.
left with that 30% balance there, or more, after the insurance claim. Usually those products are priced modestly, so they're priced less than if you'd gotten them at the dealership,
Hmm.
and so it it's not an initial turnoff usually to the consumer, and you have very high adoption rates by the consumers. So that's how generally the refi shops make money, because you can't put the money, you can't put the cost on the consumer. The consumer's there to save money,
Yeah, yeah.
and get a lower rate, but yet the financial institution also has to make money on it too. So you can't put too much of it on there.
So you got to find a way to square the circle, so to speak, and
Yes.
the ancillary products help. Well, Jay, this has been a fascinating conversation. I have the same three questions, and I'm really curious your answers that I ask every guest at the end of these sessions. So I'd like to throw them out to you now and see what you say. My first one is, what is the best piece of career advice you've ever gotten?
Wow. Well, it's probably a bit more obtuse here, not relevant here, but it was always treat the people who work for you, um, that treat them the way you want to be treated. Make sure you uh, take care of their pay, um, care about what they do, and always pay attention to their family. So
Family.
that's actually helped me, I think, a great deal, because I'm blessed to, when I got here at PenFed, there was I had a team of three, and we've been able to build it to over 45 people. And a lot of those people followed me from other places, where they've worked for me. So um, I guess I'm doing something right in that respect. So I'd like to think that piece of advice has helped me out a lot. The other thing that you talked about was, hey, whether you call it stealing, mimicking, or whatever the case is it's okay if you didn't come up with the idea, and you want to use it. That's there are some original ideas. I don't know if I've ever come up with one, but
Yeah,
I think
it's
I've
a
been a
kind of
good borrower.
I love that because particularly in Silicon Valley, there's occasionally I think people get obsessed with the idea of the great idea. And I'm like, the idea is a little bit of it, but so much of the success is the execution of that idea. And it's not, you should be willing to find a good idea. And then success is not always who had it first, but who can actually go and take what may not even be, take that concept and execute it well. All right.
Exactly.
Second question. What's the best advice you've gotten about the consumer lending space?
Well, that was from Nigel. So just, create your origination levers. You can't have too many levers. I'm sure that you can, but the more levers you have, the more flexibility you have, and the more channels you have, the more flexibility you have. And even if you're going to move forward in the space, and you're not really sure, if it's going to be a big deal or a small deal, if you don't move forward with it and sign the deal and get it set up, you miss 100% of the shots you don't take. So
I like it. Lots of levers.
lots of levers.
Lots of levers. We love different. I think of those knobs and controls, but
Yes, exactly.
different ways you can drive things. And my last question for you: what's one bold prediction for the future?
Bold prediction.
Bold,
Um,
bold is in the eye of the beholder.
I'm here again. Not having a lot of great original ideas. I'd probably just borrow some from other folks. Just I don't see a way that we don't have some type of correction here,
Mm.
in the next 6 months, when I think you're going to see a rush of rates going up, with a 50 basis point change probably happening on May 3rd. All of a sudden, everybody's going to be raising rates. And I don't know if everybody's fully understands that all of a sudden, when all the banks start raising rates, and then credit becomes harder to get, and then the shock impact to what's going to happen out of this. I understand they need to slow things down, but I think you'll see some type of pullback
Some
that's
type
going
of
to happen.
pullback in the next couple. I don't know. I've felt recently that I've never experienced a time where the range of seemingly possible outcomes from a macroeconomic point of view over the 9 month horizon was wider. Like there's some sense of like things could correct and be good, and supply chain could straighten out, and inflation could, and then there's a sense that like could go the other way real fast and accelerate. And
Look,
it's you usually feel like it's a roughly narrow window of where you might be in 6 months, and right now it feels wider than normal.
we live in times of pandemics and murder hornets and all sorts of other crazy stuff
So
going on. So I've been proven wrong already. That when I first saw the first inverted yield curve and thought that we were heading into recession after that, but it seems with the revisitation of that and now all of the other things that are all kind of coming together at this point, it seems it's going to be really hard to avoid a correction. So.
yeah, I think that's a fair prediction. We'll let bold stay in the eye of the beholder.
I don't think it's bold. So.
Well, best predictions are accurate; they don't have to be bold. Anyway, Jay, I appreciate you making the time. This was really interesting, and I appreciate you sharing your thoughts.
Thanks, Jeff. I really appreciate it.